Hi, and welcome to another episode of Coffee with Brendan. Today's episode is based off of an email I received from one of our longtime clients. He wanted to know that since the market had started the year and pretty much steadily went down between January and June, so the first 6 months of the year, why has it reacted so positively in the last couple months, which would be July and August of 2022? Is this just a fluke, or is this something that has some merit to it? So that's what we're going to talk about today. What are the three main reasons why the market has recovered, and what a recovery like this typically signifies for the future prospects of the market. So let me jump in and we'll kind of set the stage. So if we take a look at the market, this is pretty much what my client was referring to, is that if we look at year to date, we started the year off and just pretty much steadily went down. We had a nice little recovery between March and April, then went pretty much straight down from there and bottomed out right around mid-June. Since mid-June, we've seen a nice little run until just recently. today's an exception to the rule. It actually has dropped pretty dramatically today. Hopefully, we'll get a little bit back. But long story short, it's had a pretty nice recovery. And if you look at the 52-week range, it bottomed out about 3,600, topped out at about 4,800, and midway is right here. We had been up until last week past this 52-week mid-range, but we've kind of dipped right back to under the 50% dip. But let's get into why that is. So as I mentioned earlier, there are three main reasons why the market has had this nice recovery between or the last couple months, July and August 2022. So the first thing is that unemployment came in much better than what we had anticipated. Specifically, U.S. employers added 528,000 jobs in the month of June, which was significantly better than what economists had expected. They actually expected it to be more like 250,000. So the number of jobs, and this is just kind of investing 101. The market builds in a lot of assumptions. And if the assumptions are here and the news that comes out and the actual news is up here and twice as good, then the market's going to go up, and vice versa. Had the economists thought that it was 250,000 jobs and only 100,000 came in, that would have been looked at as a very negative thing. And why are jobs important? Because you've probably heard, and we even did a video on this, is that recession. Recession is typically signified with the economy contracting, but also job loss. And the fact that the jobs are actually going the exact opposite way, and employers are actually hiring people as opposed to laying people off, is a positive sign that a recession may not be in the cards, even though there's still some strong signs that they are. So there's been this like tennis match between people that think that the market's going to go into, or I should say, the economy is going to go into a recession, and the other side who don't believe that the economy is going to go into a recession. So that's number one, is that jobs came in much better, which kind of pushes or makes the argument that a recession will not happen. And typically, when a recession doesn't happen, the market does not fall as dramatically as if there was a recession. So that is number one. Number two is that the inflation numbers also came in better than what was expected. So again, the market had anticipated the inflation rate being here. Inflation was actually a little bit lower, and so therefore the market jumped. And so that was number two, and again, this is something that has plagued us since the beginning of the year and pretty much throughout the year, is the cost of everything going up. And one thing that really significantly kind of moved the needle in July was the price of gas. Price of gas has come down probably about $1 from its high, and that is a big part of the inflation number. And so when one of the major parts of the inflation number come down, guess what? The inflation number comes down. And so the economists had believed that they call it the CPI, which is the Consumer Price Index, and that is the measure of inflation. And they had a certain assumption. It actually came in a little bit better than their assumption. And then the final thing that I don't know if I can share because my compliance department probably would get mad at me is earnings. So what is that? So at the end of the day, I try to remind all of my clients, and I probably said this to you if you are one of my clients who's watching this, that the stock market at the end of the day, yes, it's impacted by geopolitical events. Yes, it's impacted by what happens in Washington. Yes, it's impacted by all sorts of different factors. But at the end of the day, the stock market is a temperature gauge of what's happening in business and in the business world. And so the third thing that has been positive over the last quarter has been earnings. In other words, profitability of different companies. How are companies faring with these supply chain challenges, with the inflation, with the fact that consumers are starting to pull back their spending and not spending as much money on different goods and services. And the market pays very close attention to earnings, and specifically the big companies. So if you look at the Fortune 500 companies, are pretty much the 500 companies that make up the S&P 500, you'll see that this earnings season, about 3/4 of them outperformed what economists had actually expected. So once again, you have a certain set of expectations that economists come up with, and when the actual results are that much better, the market moves up. So really, it's those three things. So let's just summarize again. Jobs came in better than expected. Inflation numbers came in better than expected, and company earnings came in better than expected. So all three of those things have come together and have pretty much led to this big rise that we have seen over the past couple months. So one of the reasons why I'm shooting this video is because this little Waymark, this little 52-week range, the midpoint, where it goes all the way down, but it needs to come back. Once, I'll put it this way, the market has dropped 20%, 13 times since the World War II. And every single one of those 13 times, so 13 out of 13 times, when the market has gone down 20 and come back halfway, that signifies that that the market will not touch again that low. So there's an argument to be made that historically speaking, I'm going to be really careful with how I word this, but historically speaking, 13 out of 13 times when the market has gone down and come back halfway, that typically means that it will not go back to the lows that it had seen. So in the case of here, the market went down to 36, 36. And what this is pretty much saying is that if history repeats itself, not a guarantee, if history repeats itself and the market comes back halfway, that typically means that we will not see another 36. So hopefully that wasn't too promissory. I'm just pretty much saying that historically speaking, it's a good sign when the market comes back halfway. Not saying we're out of the woods yet, I do think there could be some additional volatility. If we look back at the last time that we had a situation like this, the market, it was 2011. The market went down over 20%, came back, but then went down another 10% right after it came back. So again, we're not out of the woods. There probably will still be some volatility. We still have a midterm election. Midterm elections typically create some volatility. But if history does repeat itself, the worst may be over. So hopefully that was safe enough so my compliance department will let me get this video out to you. If not, then we'll have to reshoot this. So that's all I got for you today. I hope this was helpful, and we'll look forward to our next coffee with Brendan. Take care.